Hello Sector Watchers, welcome to the show. This is the 96th episode of Sector Spotlight for Tuesday the 14th of September, recording it on Monday the 13th. My name is Julius the Kempenaer and I am presenting Sector Spotlight to you from Amsterdam in the Netherlands. If you want to stay in touch with me, have any questions or want to share any comments, please use any handles on the screen right now. And regulars know that I will do my very best to respond to you as good as possible and as fast as possible. May not always be the next day or the next week, but in general I try to answer each and every message. So today we're going to take a look at the rotations in asset classes and sectors as usual. See if we can find any meaningful rotations, trends, patterns, etc. And I will also try to bring up some of the lesser used RRGs that we have in the drop-down box. And if there is some time left, I'll try to answer a few, well, not very specific user questions in the mailbag, but a lot of questions are coming in terms of what are your best buy point, when are you buying, what is your strategy, what are your rules, etc., etc., etc. So apparently that's still high on your wish list to discuss that even more. And I'll try to accommodate that. So right now we're going to start with rotations for asset classes and sectors. What happened with the rotations in asset classes last week? We have the weekly RRG on the left-hand side and the daily RRG on the right-hand side. These charts end on Friday the 10th of September. As you can see, it was a weak week for the benchmark, VBINX, the Vanguard Balanced Index Fund. And for those of you who don't know or remember what that is a fund that holds 60% in stocks and 40% in various bonds. It's a benchmark that is well served as a benchmark for RIAs, investment advisors, etc., where asset allocation plays a role. If we look at the other asset classes, then you can see that commodities are coming out on top, DJP and GSG. DJP picking up 50 basis points, GSG lost 10 basis points, but with the benchmark losing 1.2%, that's actually pretty cool. And the dollar picked up again 40 basis points, so we'll have a look at that later on. For the time being, we're saved by the bell in the longer term projection that I had on for the US dollar. It looks to be as it was a risk off week, I guess, because ITOT and VNQ, which are the most prominent risk on asset classes in this plot, both went lower. Stocks went down 1.9% and VNQ real estate went down even 4.1%. And Gov, high yield and corporate bonds, they all were above the benchmark, but still they lost in value and price. If we look at the effect of the rotations, then we can see that ITOT, the stock market, still inside lagging, but it started to rotating, to roll over inside that leading quadrant. Basically on Tuesday, Wednesday, where you saw that, and then a couple of days close together, and then moving further down. So it's now at a negative heading, and the opposite rotations are visible in Gov, that's government bonds, LQD, that's corporate bonds, and high yield bonds. So they're starting to pick up. Stocks still on the right-hand side, bonds still on the left-hand side. What does that mean for the longer-term picture? How does that pan out for the longer-term picture? We can still see that VNQ is the strongest sector over a longer period. It's the highest ranked sector or asset class on the JDK-RS ratio. Inside weakening, but starting to pick up. So I have to wait and see how this tail here on the daily is starting to work out in the coming weeks. For the time being, we're going to judge this as sort of an outlier. It was a pretty weak week, but if you look at the strength of real estate, then it's still far away to the right. So still pretty strong versus the benchmark. Stocks also still pretty strong. the last week we're moving lower on the RS ratio scale. That's not so good. So maybe we're slowly getting to an answer about what the real direction of the stock market is, because we're still sort of in limbo on that. One week it's all about stocks, the other week it's a weak week for stocks. Not a very clear picture. I've called it out as frustrating, as confusing, as conflicting sector rotations. All of that is still pretty much there. We're going to look later on when we're watching sectors to see if that image is getting clearer, if any more meaningful signals and rotations are coming out. Longer term picture, Gov, the whole fixed income complex still on the left hand side, and US dollar actually pointing lower and starting that. It's almost at the same position last week, and if you look at the daily rotation, then you can see that it, especially towards the end of the week, it started to pick up. Still moving lower there, so we're not there yet, but we see some improvement. Other than that, I don't think there are many things to discuss here with regard to asset classes, so let's have a quick look at some of the charts that belong to this group. This one is I'm keeping an eye on this recently, because this is the number of new 52-week highs. So weekly charts was a little bit longer term outlook, and I'm comparing it to the S&P 500. And what you see here is a very steep decline in the number of new 52-week highs, while the stock market or the S&P continues to climb higher. And that is a discrepancy. That's a maybe call it a divergence. I don't know, but normally when you see a strong market, you will see new 52-week highs moving higher. That corresponds with a rising market. And this is not corresponding with a rising market already since May. So what this basically tells you is that the last bit, or basically since May, the rally in the stock market is carried by only a handful of stocks. Because there are some names, the big names, we all know them, that have been pushing higher. So the base for this rally is very small, and it's getting smaller and smaller and smaller. So I suggest you keep an eye on this as well, because it's not an ironclad, guaranteed indicator that gives you all the signals, but it's a very clear metric on breadth, on how solid the foundation for the current rally is. Let's take a look at the S&P itself. If we look at SPY here, then we see that trend channel is still intact. Outperformance versus the S&P 500 still there. All the problems that we've described and showed over the last few weeks, they're all still there. If I go to the zooming in on the SPY charts, then here is the daily, and you can see that we now have again a new negative divergence building up and actually working out on the daily. This is the RSI, where the last peak wasn't able to go above the previous peak, while in price that is exactly what happened. And if you look at the weekly chart of the S&P 500, you see that the negative divergence that we pointed out here a couple of weeks ago, and then after that it seemed as if that negative divergence was going to be negated. I even drew that little dotted line there at some stage. And now since last week you can see that it is pretty much back in full swing. And I've also added the MACD here because that's a little bit more trendiness, a little bit more trend following indicator. And you can see that that negative divergence here is also still fully intact. Still a lot of signals, a lot of information, a lot of evidence suggesting at least a pause in the rally of the S&P 500. So we're going to continue to watch that development and see how it pans out further. Commodities still pretty good. DJP holding up well above resistance, pushing to above its recent highs. So that's a good thing. So that long-term trend change in commodities continues to work out. GSG here needs to pretty much take out that resistance here, or 16.5, 1670. Going through a little bit of a sideways movement, but this was a pretty big rally. So I don't mind. I still think that long-term turnaround is intact. Let's quickly have a look at the US dollar, because we had an interesting chart on that recently. I said it was a big head and shoulders pattern. Let me bring that back to the bar chart that I used, and we broke that neckline. That was sort of the trigger for a potentially big decline, and then we got back above it, and that's why I changed that, or I changed that chart to a line chart to work with the closing prices, and then you can see that the neckline is angled slightly higher, and the line we pulled back here to this 118.80 level, and we're now getting off. It's not super strong anymore. It's not as strong as it used to be, but it looks as if we're sort of, I don't know, saved by the bell for the pattern. Very clearly now, when you get above, let's say 118.75, 119, then this whole pattern is a goner. Then it's not valid anymore. For the time being, I continue to watch this as a potential longer term trend change for the dollar, which means the dollar getting stronger. That's basically the most important message as it stands right now. It's not a guarantee, as I said. It's the pattern used to be stronger. I liked it when it was a real clear-cut head and shoulders. It's still there, but I need to go to the line chart to make that happen. I don't know. It's getting tricky. I would have preferred a very nice break here, a very clean break, and then a nice follow through. That didn't happen yet. If we now get a nice decline here in euro dollar, so gain of the US dollar, then we can still work with this pattern and the signal. Otherwise, we'll have to ditch it and start looking for new information on this chart. Moving to the rotations for sectors as we've seen them last week, gives us the following picture. On the right hand side, the daily RRG. On the left hand side, the weekly RRG. If we start with the daily, then this is the chart as it was on Friday the 10th. We have now added today, so if I add one more day, then we have the last 5 trading days. You can see what the impact of one day of price movement is of this chart. And last week was actually, pretty weak, 1.7% loss for the S&P 500, 3.9 for real estate. We already saw that in V&Q, but also, industrials, healthcare, utilities, all, losing 2.5%, way below the S&P 500. Outperformers: staples, communication services, tech, and consumer discretionary. And for the week, all sectors were lower. If we add today, then we see that energy picked up. It was a very strong day for energy today. That brings it over the last 5 days to a gain of 1.1%. S&P still lower, and you can see the rest of the list here. Let's try to see if we can find alignment or disalignment. Is that a word? Where they don't align between the daily and the weekly tails. So the way I do that is I sort both tables on the symbol, and then I can just highlight them. So if we start with materials, then we see that both tails on daily and weekly are inside the lagging quadrant. On the weekly, it's picking up over the last 4 weeks already in momentum, not so much yet in relative strength. And on the daily, it's still moving lower on relative strength. All in all, I don't think that is a super strong sector. Probably not the weakest, but if you look in terms of RS ratio, it is the second or the third weakest, but it's picking up some momentum. But definitely not a strong outperformer or expected strong outperformer. If you go to communication services, then you see that on the weekly, it's a very short tail, which means that the trend is stable. It's on the right-hand side. It's very close to the benchmark and very close to 100, so it's moving in line with the benchmark. It's not a lot of deviation. If I play around with the tail here, then you can see that it is starting to curl up, just shaving off that 100 level on the RS ratio. And you see why that happened, because this is over the last 2-3 weeks. You can see this improvement and a rotation, and it's now starting to roll over again inside the leading quadrant. So this sector is in line with the benchmark and does not have a super strong trend. So the way I see this as alignment is that we will have to wait and see whether the strength of XLC as it is right now on the daily, where it is still the second highest on the RS ratio scale, can be maintained and will be strong enough to pull that tail on the weekly back up towards leading. Energy had a very good day today, and you see that it is on the daily RRG moving to the right, but not picking up a lot of momentum, and it still has a low reading. And if you combine that with the weak tail here, which is deep inside lagging, picking up a little bit of momentum, but not very much, as you can see, it's disconnected from the rest of the sectors. And not so much on the daily, but it will need a lot of relative strength and a lot of price movement before the energy sector can be pulled all the way to leading, let alone that it can pull this long tail back into the improving quadrant on the weekly RRG. So this definitely is one of the weaker sectors for me. We go to financials, then you can see that this is also inside lagging, picking up a little bit of momentum. Here we see that the daily RRG, the daily tail, is now pushing rapidly into the lagging quadrant. So with a tail like this, it's very unlikely that this improvement for financials can continue at short notice. We will have to see a rapid turnaround on the daily tail before we can continue a continuation higher, or at least a pickup of momentum higher on the weekly tail for financials. So it still remains a weak sector, especially with the renewed weakness on the daily RRG. We go to industrials, then you can see that it is inside lagging, and that is confirmed by the daily tail. So the industrial sector, weak tail on the weekly RRG, a weak tail on the on the daily RRG. Again, not a very strong sector, not a very strong outlook for this one. Technology, inside leading, but rolling over on the weekly. And here on the daily, you see that, especially this week, it's almost a vertical move down. That's a very momentum-driven move for the technology sector. It's hitting the weakening quadrant today on Monday. Friday was still green, right now it turned yellow, moved into the weakening quadrant. We'll have to see if this rotation, if this can remain, because it's the third from the right, which is still relatively strong. But we do need a pickup in XLK and bring it back up to facilitate a longer stay for XLK in the leading quadrant here. So it's in the short term, it looks as if XLK has lost its mojo, it's lost its momentum, and the question is whether that loss of momentum will be strong enough to pull it all the way down to weakening and to lagging. So it's definitely not as strong as it used to be in the last few weeks. The strongest sector, a turnaround you see for staples, not so much visible on the weekly. You see it's very stable, but you see the rollover, the curling back up here on the weekly RRG, and it's very clear on the daily RRG, where it's coming out of the lagging quadrant, pushing back up at a nice strong RRG heading. So staples seems to be starting to support an improvement on the weekly RRG. That is a nice alignment. So staples is starting to align and it's starting to move towards the leading quadrant. And remember what we said, when defensive sectors start to outperform, start to show a good heading, what does that mean for the market as a whole? If we look at real estate, inside the weakening quadrant here, inside leading there, that weak that we had so far, not really a major problem as far as I'm concerned, especially the improvement on the lead on the daily RRG where it's pushing further into the leading quadrant. It could very well pull this weekly tail back up from the weakening quadrant. As you can see, XLRE is still the strongest sector on the weekly RS ratio scale. Utilities was already strong for the last couple of weeks. And you see that despite the weakness that we had for utilities here over the last couple of weeks, started to roll over. We now have an almost vertical move on the RS momentum scale, and that starts to be coinciding with the improvement on the weekly RRG for utilities. If we can maintain this pace, if we can maintain this momentum and start moving to the right on the daily RRG, then it's coinciding with the tail in utilities, and we have another defensive sector that is starting to move towards the leading quadrant. We go to healthcare, rolling over inside the leading quadrant. You can see why that happened. That's the effect of the last few weeks of weakness for the healthcare sector when it started to roll over inside leading. We're talking about late August here. And then started to move through weakening into lagging and now starting to pick up. We can continue to pick up this improvement here, then we can probably maintain the position for the healthcare sector in the leading quadrant, but it needs to happen rapidly. So the best rotations right now for utilities and staples, probably both defensive sectors. And finally now the discretionary sector. We see that the tail here is very short, compare it to these others, a very short tail for discretionary. We have a rapid move over the last few weeks where discretionary moved from lagging into improving, now moving into leading, but it's at the flat momentum, so there's no gain in momentum anymore. If the daily tail on discretionary starts to roll over, that's a negative sign, and then it starts to support the further rolling over for the discretionary tail inside improving. So keep that in mind. So probably the strongest rotations, utilities and staples, those are defensive, and a potential more negative rotation for discretionary and also technology rolling over here. And we definitely have to keep an eye on those four sectors, I think. I just noticed that I have wrecked my own time schedule. We've got about 4 minutes left in the show, which is not merely enough to discuss the items that I mentioned, like the more esoteric RRGs from the drop down and an explanation of where to buy and things from the mailbag. So I owe you an article on the more esoteric RRGs, and we're going to spend another show on, maybe just do another show on just mailbag questions, just theory and background and education instead of markets. I want to talk more about the four sectors that we just identified. The two defensive ones, utilities and staples. I think they're an important indicator for us right now. If you look at the daily tail for utilities, it's clearly heading towards the leading quadrant. That's a pretty clear-cut trend, and it looks as if it's going to continue. If we bring up the chart here, then you can see that it's holding up well above its breakout level, and it's pushing against its all-time high around 70.6. So if we can take out that high, that's definitely a good sign. And you can see here that the relative weakness, which has been in play for the better part of the year, is now starting to turn around, and you can see that momentum has already started to pick up and RS ratio is following suit. So I'm going to keep a very close eye on utilities as one of the outperforming sectors going forward. Now the other one, very clearly a defensive sector, is staples. We showed the rotation from lagging into improving, and you can see the improvement of the lengthening of the tail between the observations. And if we bring in the chart here for consumer staples, then we see that the price is holding up very nicely above that breakout level. It's inside that rising channel, and you can see that we're sideways on the raw RS line, and the RS ratio lines, the RRG lines are starting to pick up. So utilities is leading in terms of defense, but staples is now following suit. So where does that leave us with the more cyclical stuff? And I think that the two sectors that you need to keep an eye on are technology. If you look at technology and bring up the tail here, you see that it's starting to roll over. And you can see that the tech sector, XLK, has been pushing against that rising resistance line, not able to break through. But more importantly, that last rally in relative strength, which was causing XLK to move into that leading quadrant, is now stalling against that resistance level that we saw at the end of 2020, and it's still not able to get past it. And you see that momentum is already bending downward, rolling over downward. So if this continues to weaken and weaken rapidly, that obviously will have an impact on the market. And finally, the consumer discretionary sector, which is now clearly rolling over inside the improving quadrant. And if you bring up the price chart for consumer discretionary, then the downtrend in relative strength is already there since the start of the year. That's why it's on the left-hand side of the RRG. The hiccup here that we saw from April onwards has not brought us much in terms of relative strength. And in terms of price, it was only marginally higher, and it looks as if we are now in a rising wedge at the end of a trend channel. Now, I'm very careful with calling things wedges, etc., because they're not always good patterns and they're not always at the right location. But this one, I think, is a rising wedge pattern that classifies as such, because it's the end of a rising trend. It's got multiple touch points on both the support and the resistance line, and they're converging. So if we are going to go out of this wedge pattern, and let's say that that happens when it's clearly below 180 at the weekly close, then we could see a rapid acceleration downward in the consumer discretionary sector. That's an important sector for the S&P 500, followed by technology. And if we then see a further strength for staples and utilities, I hope that the market is then less conflicting and we get what we've been waiting for and what we need in order to be able to get a new entry level to pick up again for those long-term trends that are all still there. And this concludes Sector Spotlight. Thank you for watching. You know the drill. If you like it, thumbs up. If you got anything to say, any comments, use any of the handles on the screen. We love to hear from you. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. And I hope to see you again next week, same time, same place, at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.